course, many jurisdictions have not. Then there's a second level of tax, which is, let's say you're an entity that's in a jurisdiction that has adopted the rules, but you have a subsidiary in a jurisdiction that has not. Well, then there's a collection mechanism that means that any subsidiaries, direct or indirect, their profits may be taxed in the parent jurisdiction, like a controlled foreign company charge, a CFC charge. And that means that subsidiaries in jurisdictions that have not adopted the rules, their profits can be brought into scope as well. And then finally, the third collection mechanism, which is only starting to come into scope in various jurisdictions, says, well, what if I'm not a parent of an entity in a jurisdiction that hasn't adopted the rules, but let's say I'm owned by an entity that is in a jurisdiction that hasn't adopted the rules. So an Irish company that maybe is a subsidiary of a Cayman company, and Cayman is not bringing in the rules, and maybe that Cayman company has other Cayman subsidiaries. Well, what these rules say is, well, no, you don't get out on that basis. We want to collect tax all around the world for any member of this group. So in their circumstances, the tax rates are measured, the effective tax rates are measured in all of those jurisdictions. If it's not 15%, additional tax is allocated out to the various jurisdictions that have brought in the rules, and they pay tax in respect of those other profits, even though there may not be an ownership interest in those companies. Nevertheless, tax is collected. So those are the rules. In many cases, funds will not be in scope because they simply won't be consolidated into a group. Or even where they might be, even if there's interest in those funds, they might simply be accounted for as a investment entity and therefore not consolidated. And the fact that you're accounted for as an investment entity is not an exemption from consolidation. It's the particular accounting treatment that applies to that investment. So many funds are not going to be in scope, but some will be. They may be in scope because it's a seed investor and has a potentially large investment in that entity, causing it to be consolidated for a period of time. Or there may be other issues around ownership and control that can result in consolidation, depending on the local accounting standards that apply in that jurisdiction. So what do we do in those circumstances when we have a fund entity that is in scope? First, a quick sidebar. The GLOBE rules introduced by the OECD generally require that you have a cross-border element of your group. So under those rules, a wholly domestic group that's in, say, only in one jurisdiction are not in scope. But the EU broadened that out. So all EU jurisdictions also apply the rules for wholly domestic groups. They do need to be groups. Ireland has decided under its last Finance Act to carve out all of its regulated investment funds if they're not part of a group. That is, if they're a standalone entity that's only in Ireland, then even if they were big enough to meet that 750 million threshold, which granted would not be many, they'll simply be carved out. So that's something Ireland has done. But if you're not within that, then there are particular exceptions to the rules, and there are various excluded entities under the rules, including investment entities. So an investment entity will be excluded from IIR, which is the tax imposed by a parent to its subsidiaries, and UTPR, if it is the ultimate parent entity of a group. Now, most funds that are consolidated won't be an ultimate parent entity of a group. So most funds, if they are consolidated, probably don't qualify for this exclusion. But the rules do exclude from the qualified domestic top-up tax an investment entity, even if it's not the ultimate parent entity. And therefore, that means many funds could qualify for that exemption from the domestic tax. So an Irish fund may not have to pay additional tax to the Irish government, but its investors may have to pay tax in their home country as the investors in that fund. So what is an investment entity? So investment entities cover a range of vehicles. They cover investment funds and real estate investment vehicles and insurance investment entities. We'll come and talk about what those are now in a moment. But just in addition to that, certain 95% subsidiaries that are used as investment vehicles by the fund, they can qualify, even if they wouldn't be investment entities on their own account. And certain 85% investment vehicles that are used principally to get exempt dividends, we'll talk about those in a little later, also potentially qualify for this exclusion for investment entities. So what are these investment funds? Investment fund is pretty much what you would think it is. It's a vehicle that's designed to pool financial and non-financial assets between multiple investors, some of whom are not connected. So a vehicle that's wholly owned by a group wouldn't meet that test. There needs to be some external investment. It has to have a defined investment policy, has to be there for the purposes of generating returns for investors who get a return based on the proportion of investment they've made. It needs to be subject to AML and investor protection rules in its local jurisdiction. And either it or its management need to be regulated. So an unregulated fund can qualify as long as its management is regulated. And it needs to be managed by investment fund management professionals. So largely what you would think a classic regulated fund might be. Notable in that, an investment fund could be a real estate fund, in that non-financial assets are included in that definition. But there is a separate category of real estate investment vehicle which extends that, though in a pretty narrow way, in that it requires that there is a deferral of tax, but for no more than a year with respect to the gains in the fund. So we won't focus on that, just to mention that it does exist. Insurance investment entities, that's another category. That is there to recognize the fact that insurance groups may well have fund vehicles that they use to invest. They wouldn't meet the definition of investment fund if they're wholly owned by that insurance group, because then they lack some unconnected investors. So by exception, they can still qualify as long as they're used to invest on behalf of policyholders. So that's a separate category, but essentially it's just a variation on the investment fund theme. So let's just pause there for a second. What are we talking about here? We're saying if you have a fund, it's only in scope of the rules if it's consolidated. If it is in scope of the rules, well, it might be excluded from that domestic tax, the tax it pays to the tax authorities in its home jurisdiction, as long as it's an investment fund as defined here. But unless it happens to be the ultimate entity in the group, the top company in the group, it's not going to be excluded from the income inclusion rule or the undertaxed payments rule. So those entities that are then in scope potentially for IIR, for example, what does that mean in practice? Well, it's worth noting that the general rule under the GLOBE system is that all of the profits and taxes of entities in the same jurisdiction that are in that group, they're taken together in one big pot, and a calculation is done for everything in aggregate to see, is this 15% effective rate met? And if it's not, that difference between the two, that's allocated out proportionately between all of the entities. That effectively means there's a degree of socialization between companies in the same jurisdiction. These companies might actually run entirely independently of each other. They just happen to be owned by the same ultimate parent. But that doesn't matter. If they're in the same jurisdiction, the rule is you do a joint calculation and you pro rata out the additional tax between those entities. But there is a special rule. There is an acknowledgement that investment entities, as defined, should be dealt with separately. And that is helpful. So that means that if you have multiple entities in a jurisdiction, some of which are investment entities, you say you've got a fund in Ireland, there isn't that big pot calculation where you might have non-fund entities taken into the calculation. Instead, it's done separately. If there are multiple fund entities, investment entities, in the jurisdiction, well, there is a joint calculation for those, but only for those that qualify as investment entities. That can actually be quite important and quite helpful. So if you think about it, if you're a fund that is not subject to the domestic QGTT tax, well, the tax is paid by your parent. If that parent has multiple funds in Ireland in which it's got to pay some additional tax, by blending the profits together and doing a joint calculation, you may get the benefit of, if you in one fund might have taxes in excess of 15% already in it, and the other below, by blending them together, you may get that benefit. You might say, well, look, most funds are tax exempt. Why would I have any taxes in this fund? Well, it's not just corporate income tax that any entity might pay, and most funds are exempted from corporate income taxes. Bear in mind, you could be suffering lots of withholding taxes on your investments, dividend withholding tax, interest withholding tax on bonds, or other local taxes in jurisdictions where you're invested. And many of those will count as taxes for this purpose. So although you may not be paying corporate income tax in Ireland in an Irish fund, you may well have lots of taxes. So the ability, therefore, to pool these together is potentially quite important. It's also worth noting that some dividends will also be excluded. There is a provision that says essentially non-portfolio dividends, you don't include those in your calculations unless you opt to do so. Now, that A non-portfolio here means a stake of less than 10% in the issuer and held, non-portfolio means, portfolio rather is defined as 10% held for less than 12 months. So anything that is not 10% and held for less than 12 months is non-portfolio and may be excluded. So if that's all that your fund invests in, even if it's in scope, it may not have any income to which the additional tax rate needs to be applied. So let's move on. Let's say you're an entity, fund, and you're in scope, and you have to do this calculation. Well, even if you have some foreign taxes, foreign withholding taxes, that may reduce your bill, it doesn't eliminate it. And that does rather fly in the face of what funds are supposed to be. Funds are supposed to be tax-neutral vehicles where tax is paid by the investors. And there is some acknowledgement of this in the Globe rules, that it would be unfair to impose tax at the level of the fund and then further tax when those profits are distributed to the investors. And to that end, there are two additional regimes that are allowed for under the rules. So an investment entity, as we've defined, or an insurance investment entity, it can elect to be treated as if it were tax transparent. And by being tax transparent, that means it doesn't pay tax. It's not subject to tax. Its profits aren't subject to tax under the IIR rules. Instead, all of its income and any taxes attaching to that income is simply allocated out to the entity that otherwise would have paid IIR, might have paid IIR in respect to that company, that fund. So you can elect to make your fund transparent. That means all of its income and any taxes attaching to that income are simply allocated out to the investors in the group, and they include that income and those taxes in their own domestic top-up tax calculations. So that's very helpful. It's only available where the member is subject to tax on a mark-to-market type regime, and the tax rate in that jurisdiction is 15%. That's not their effective tax rate as measured under the Globe rules. It's the domestic corporate income tax rate in that jurisdiction. Is it 15% rate or above? The effective rate might be higher or lower. That's not the question. Is the nominal rate 15 or above? You have to elect in for 5 years under this rules. If you break out, you can break out, but there is a catch-up applied in those circumstances. The other possibility that's provided for is this thing called the taxable distribution method. And that's saying, look, as long as the fund is a distributing fund and it distributes quickly enough, we'll not impose any additional tax on the fund because we know the income is going into the hands of the investors and will be picked up there for Globe purposes. So again, there are criteria here. The shareholder has to be reasonably expected to be subject to tax at a rate of at least 15%. Again, that's the nominal rate. And the distributions have to come out within effectively a 4-year period. And to the extent that there aren't sufficient distributions in that 4-year period, there's a deemed distribution and there's catch-up tax paid that way. So these are two useful options that may be available where the conditions are met. Brief mention of transparent vehicles and tax transparent funds. So there are funds out there in Ireland, like the Common Contractual Fund, like the Investment Limited Partnership, which are designed to be tax transparent. Ireland says if you form an entity here in our jurisdiction, we'll treat them as tax transparent. The Globe rules would say, as long as the member jurisdiction also treats them as tax transparent, then we'll treat them that way for Globe purposes, and therefore their income and any taxes are simply allocated out of the member. They're used in their domestic calculations, and there isn't an income inclusion rule liability for those funds. So that's the basic proposition around things that are formed as tax transparent in the jurisdiction that they're in. Common Contractual Fund, Investment Limited Partnership. But of course, it's possible that some jurisdictions might say, well, we know in Ireland they think that's a tax transparent investment limited partnership or common contractual fund. We don't treat it as that for the purposes of our investors. We will only tax the investor in our jurisdiction on distributions received. We'll treat it like a foreign opaque entity, like a foreign company. The rules do look at this situation and they say, fine, that's hybrid, a reverse hybrid entity. And in those circumstances, income inclusion rule will apply. So that member has to impose an IIR charge with respect to that foreign vehicle, the Irish Investment Limited Partnership, Common Contractual Fund, or foreign equivalents, notwithstanding that it is deemed to be tax transparent in its home country. So if you've got a common contractual fund, if you've got an investment limited partnership, you can't say, oh, that's fine, we don't need to worry, they're transparent. You do need to consider for all of the members that are in your group, do they treat it as tax transparent? And if they don't, then these reverse hybrid rules could apply to catch you. Just a brief sidebar into securitization entities. There's an acknowledgement that really securitization entities are a form of secured financing, and imposing an additional qualified domestic top-up tax charge could seriously impact their viability and their ratings and the ability to get them properly underwritten. So a rule was introduced in the last Finance Act in Ireland, and some other jurisdictions have a similar rule, but not all. And it says, look, you can transfer the qualified domestic top-up tax charge for any securitization entity to another entity in Ireland, if it's an Irish securitization entity, and it'll pay the tax instead. So the tax doesn't go away, it's just paid by another entity. But you have to have at least one other entity in Ireland. If there isn't at least one other entity in Ireland, then this exception doesn't apply. Securitization entity here is reasonably narrowly defined, so not every Section 110 company, for example, will be a securitization entity. It really depends on whether they meet these conditions. So it needs to be carrying out a securitization arrangement, which is a pooling or repackaging of assets for investors, and one which contractually limits the exposure to investors. It has to grant security over the assets to the creditors. It has to pay out cash to investors, and it has to reserve only a nominal amount for the true, real legal equity holders of that vehicle. So this is helpful if you're in a securitization situation and you don't qualify as an investment entity. Securitization entity might qualify as an investment entity, even if it's not regulated. If its management is, it could meet those other conditions. But if it doesn't, this is at least a way of making sure that the vehicle itself is not exposed to qualifying domestic top-up tax. The tax is still paid just by somebody else. So I want to wrap up with just something on the UTPR and countermeasures. So as I said at the start, most funds won't be in scope of Pillar 2 because they won't be consolidated into a group. But that third mechanism of collection, which is this under-tax payment rule, which says entities that are in the group that are outside of a Pillar 2 jurisdiction, even if they're not owned directly or indirectly by entities in a Pillar 2 jurisdiction, they can still be caught. And those rules are coming into force shortly. We're actually in a safe harbor period at the moment, which says, look, as long as the corporate tax rate in the other jurisdiction, the nominal rate, is above 20%, well, then we won't bother testing in that jurisdiction. We'll just assume that we don't have any additional tax under UTPR. But that's a temporary measure. And there are lots of people in the US in particular who are lots of people globally who are very unhappy about UTPR, but the US is particularly vociferous about it. And there are a number of proposals to implement countermeasures. Two mentioned here, but there are some others. And one of particular note is on the left. And this is being put forward by the chairman of the Ways and Means Committee in the US. And it's saying if any jurisdiction has a UTPR on its books, or a digital services tax, by the way, well, then we are going to impose countermeasures on them. And that would be to deny all treaty benefits, and then to add 5% withholding on top of the standard withholding of 30% each year until it hits 50%, so over 4 years. So an Irish fund, not in scope of Pillar 2, but is in Ireland, and Ireland has UTPR on the books, could be caught. And that fund might be getting dividends from the US, where at the moment, under the treaty, it's reduced to 15% from 30. Well, that goes up to 30, plus 5, 35, and then over the next 4 years, up to 50. Now, this is not the law. This is a proposal put forward by the chairman of the Ways and Means Committee. There are other proposals. Not by any means certain that it will become law, but it's certainly being talked about, and this is a senior Republican, and therefore it has some weight. So even if you're not in scope of Pillar 2, because you don't meet the definitions to be in scope, that doesn't mean you couldn't be affected by Pillar 2 if some kind of countermeasure like this were implemented. So although we're all focused on tariffs at the moment with the US, this is another thing going on in the background that needs to be carefully watched in the funds industry. So I can see we're coming up on our time. Gary, are there any questions?
There's a couple of questions that came through, Garrett, so we might just go through them. So the first one is in relation to the collection mechanisms, asking if there's any practical significance to a fund being caught under the income inclusion rule rather than the qualified domestic top-up tax.
Yeah, so absolutely. And yeah, so absolutely, there is a big difference. So qualified domestic top-up tax, if that applied to an entity, so if it didn't meet the definition of investment entity, therefore wasn't excluded, well, that applies to 100% of its profits, and it's paid by the fund. So if, for example, you had a fund vehicle, but it didn't meet the definition of investment entity, let's say a promoter has a 20% stake in it, and that causes it to be consolidated because of the particular circumstances. Well, if QDTT was payable, that's payable on 100% of the profits, and it's payable by the fund. So all the other investors are now affected because the tax is in the fund and it's 100% of the profits. Under IIR, the tax is paid by that 20% promoter investor only. It's paid itself directly, not by the fund. And it's only paid on 20% of the profits because that's the stake the investor has in the fund, not on 100%. So there's a really big difference between the tax under QDTT, which applies to all of the profits, and under IIR, which is only the relevant percentage and payable by a different person.
Yeah, that's a very important consideration. The other question that came through was just about additional tax payable and whether having kind of multiple funds in a jurisdiction being caught would have a big impact or not.
Yeah, I think it does. And as we touched on, there's this possibility of blending, jurisdictional blending, which applies. And if you've got multiple funds, you will effectively blend between them. And because you might have different withholding, so you might have paying corporate income tax in those funds, but you may have withholding taxes or other taxes levied on those funds. So by blending them together, you potentially have an opportunity there to benefit and to basically share extra tax paid in one fund with a fund that hasn't paid enough tax under the Pillar 2 rules. And also, as I mentioned, the dividends that are in scope, any non-portfolio dividends are excluded by default, and gains or losses on non-portfolio shares are excluded by default. And portfolio, for these purposes, means less than 10% held for less than a year. So, but you can opt to bring them in. So there is some planning there to say, well, these dividends are out by default because they're not portfolio, but maybe there's lots of taxes attaching to some of those dividends. So might I opt in that case to bring them in if the taxes on those are above 15% and I have another fund over here which has portfolio dividends and so they're in scope, and I can now blend. So there is some planning that can be done at the investor level if you've got multiple funds, but you obviously have to carefully game that out, and you have to bear in mind you're locking in for 5 years on some of these elections, so you have to think about the future.
Yeah, very important consideration. They are all the questions that have come through, so we can kind of wrap it up there. So just like to remind everyone, our final webinar, which is a legal and regulatory update, is this time next week on the 30th of April. So hopefully you can join us for that. So thanks everyone for your attendance today, and thanks Garrett for a very insightful presentation. And hopefully we see you all soon on a further webinar. Thank you.